In a past video, this one, how to make money trading forex, I mostly focus on the mathematics side of that question. We talked about lot sizes, leverage, and margin. In this video though, we are going to talk about the different approaches that you can take in forex trading. Hi, my name is Winnie and I make forex trading related videos especially suited for beginners. If you're new and into this kind of content, kindly consider subscribing and hit that bell icon to get notified every time I drop a new video. Without further ado, let's get started. Today's episode will be a whiteboard session. So I have the whiteboard and I have the pen here to be able to explain a few things that we are going to talk about in this video. In a past video, I have mentioned that there are three main approaches in forex trading. So there's technical analysis, there's fundamental analysis, and there's hybrid analysis, which is a combination of these two. But before we explore these different approaches, let's refresh our minds and go back to basics. So the whole thing about forex trading is all about the prediction of price movements in the forex market. So price largely moves in three ways in the market. It's either going to move up, it's either going to move down, or it's going to move sideways. So if you predict that price is going to move up and actually price actually does move up, you end up making a profit. But let's take a scenario where you predict that price is going to move up, but what it does instead is it goes down. Then in that case, you're going to make a loss. So for you to be able to predict these price movements, now this is where these different approaches come in. So let's say, for example, that you want to predict price movement in the forex market and you use technical analysis. So using this approach, you predict that using this approach, it's going to help you to predict this price movement beforehand, before you actually take the trade. So let's start with the first approach, which is technical analysis. So in past videos, I have mentioned that I am a technical trader, meaning I use technical analysis to be able to predict future price movement. By definition, technical analysis is the study of historical price movements and price patterns with the goal or the intention of forecasting future price movements. So the whole thing, the basics about that statement is just three words, which is price leaves clues. So by going back into historical data, you'd be able to identify certain patterns or certain clues that price leaves behind, and which will help you forecast future price movements. Let's say at the time of filming this video, today is December 15th, 2021. So let's say you decide to go back in time and study price movements on the chart. Let's say you decide to study data between Jan 2018 to December of 2020. And from your study of past data, you identify that there's a certain pattern that keeps forming over and over again. That's, let's say, maybe every time price moves up in this fashion, price often falls to the downside. So what you have essentially done is you have identified this pattern here. So with this knowledge or this information, that when price develops or forms this certain pattern today, which is December 15th, you'll be able to predict that there's a higher likelihood that price is going to move down compared to moving up. So this is what technical analysis is, and it involves the study of the application of very different patterns. There are so many patterns out there. There are things like ascending channels, descending channels. There are bull flags, bear flags, things like support and resistance. But don't worry about any of that stuff. I promise to make future videos about them so that you can be able to understand and also apply them in your trading. But for the sake of this video, let's explore one pattern called bull flag. So a bull flag. So as this word suggests, that this pattern mostly looks like a flag, a kawaida flag. So you have this here and you have this flag. So this pattern often develops when price moves aggressively to the upside, forming the pole of a flag, and then it somehow just stalls. It somehow just stalls and doesn't really move anywhere. So when this pattern develops, it has formed a flag, just like this one. It has formed a flag. In most cases, when this pattern develops, it's an indication that price is going to continue to the upside. So what you have done, so by price forming this pattern today, you can be able to take a long position on this trade and be able to take advantage of this movement, and you make a profit in return. So let's look at the second approach, which is fundamental analysis. But by definition, fundamental analysis is the study of economic data to be able to predict the movement of price in the market. Now, as fundamental traders, they're mostly focused on reports that are released by governments and agencies. So by studying this information, they'll be able to predict the supply or demand of a currency. Now, these two words are important: the supply or demand of a currency. So let's go back to basics. When there's something excessive or in the market or in the economy, meaning there's an increased supply of something in the economy or in the market, it often means that it affects price, and in most cases price is affected negatively. So let's take an example of something that's happened very recently. So my uncle was telling me the other day about ndimus, lemons, and he tells me that back in the day, or a few years ago, that you could buy a bunch of lemons, ndimus, for close to nothing. And then 2020 happens and COVID happens. And when COVID happened, it just increased the demand of lemons in the market. And when there was an increased demand of ndimus in the market, there was limited supply, which caused price to just shoot up. So the same concept in another example can be related to tomatoes. Now, tomatoes are a staple in a meal. Now, you make tomatoes with almost every meal, and they are very important. So when there's increased demand for something, but there's limited supply of it in the market, then it also causes price to just shoot through the roof. Now, if let's say the weather has been so good and the farmers were able to harvest a lot of tomatoes, then it increased the supply of them in the market, then in most cases price often falls. So the same concept of supply and demand can be applied to currencies. Now, when central banks are the bodies that are often responsible for controlling the supply or demand of a currency in order to regulate or control the state of an economy. So when the economy is not doing good, so the central bank can intervene and seek to increase the supply of a currency in the economy. And they can do this in mostly two ways. So they can either print more money, or they can be able to lower the interest rates. So let's say, for example, I would like to take a 100k loan, and the current market rate, the current interest rate in the market is 10%. So with my 100k loan, this is the loan that I want to apply for, and I'll be able to repay this loan with an interest of 10%. So this means that the interest rate alone would be 10% of 100,000, which would mean that I would repay this loan with an interest charge on top of 10,000 bob. So let's say the central bank intervenes and they reduce the interest rate from 10% to now 7%. So with the same calculation, now instead of repaying the 100k loan with 10,000 bob as the interest charge, then I would only be able to repay this 100,000 bob with 7,000 of interest. So by reducing these interest rates, it becomes now more attractive to borrowers. Now let's think this on a large scale basis. So let's say I own a factory. So by factory, and the central bank intervenes and it has lowered the interest rates. So because I'm a factory owner, I would like to increase the production. It would mean that maybe I'll take a loan of, let's say, 10 million. So with this loan of 10 million, I'll be able to now increase the production of my factory. And to be able to increase the production of my factory, I would have to hire more and more people to come and help me with the increased production. And as those people are hired, then they'll be able to also increase their own spending in different ways. For example, they can be able to move into maybe nicer neighborhoods. They can be able to take their children to better, a bit more expensive schools. They can be able to spend more on entertainment. So as you can see, there's a lot of circulation of money in the economy, and that's how the central bank intervenes to be able to increase or improve the state of the economy. But someone who explains this concept far much better than I can is someone called Dalio, and I think he has a video here on YouTube called "How the Economic Machine Works." So for those who may not know, Dalio is I think one of the best hedge fund managers out there, and he runs I think the biggest hedge fund in the world. So if you're interested and would like to learn more about that concept, I'll attach a link in the description box below for you to maybe watch that video. But let's go back to fundamental analysis and the concept of supply and demand of currency and its impact on price. So we have already established that if there is an excessive supply of something, price is often negatively affected. So if there is so much of something, then price is expected to drop. And actually this is one of the things that I find interesting about fundamental analysis, is that there is more than meets the eye. So I'll give an example of March 2020. So on March 2020, this was the time when the COVID pandemic was at its peak. And to be able to counter the negative effects or the impact of COVID on the economy, the Fed, which is the American central bank, decided to increase the supply of dollars in the economy. And they did this by buying bonds. So they bought billions and billions worth of bonds, and they debited and credited the major banks, which in turn lent out the money to businesses or individuals. So that's how they were able to create billions and billions of dollars in the economy. So I came across this very interesting statistic that said that 40% of all dollars in circulation in the global economy were created in 2020 alone. So these measures were meant to help the American economy deal with the expected negative impacts of COVID. So anyone would expect that, given that there's now an increased supply of dollars in the economy, that the price of the dollar would be affected negatively and it would fall. But as you can see in this chart here, that when these measures were implemented by the Fed, price instead just continued moving on up impulsively or aggressively, creating new highs. And it did this for consecutive number of days. And that maybe perhaps one of the reasons could be that during this time was a time of a lot of fear and uncertainty in the market. And when during these types of periods, investors often tend to buy more dollars because it's a reserve currency. So a reserve currency is one that is expected to maintain or increase in value during uncertain times. So the US dollar being a reserve currency maybe made it more attractive for investors to even buy more and more of it, thereby increasing the the price of the US dollar. So But if you're interested in fundamental trading, maybe one of the reports or information that would be very influential and important in your trading include reports such as inflation reports, the reports released by government, the gross domestic product, which is the GDP. Also data about the consumer price index, and maybe employment data. So as I mentioned a bit earlier, I am more of a technical trader, but I love things surrounding the fundamentals, fundamental analysis, because I believe in I'm one more to explore the things or the information that largely focuses or informs the forex market. But if you're interested and would like to learn more of this information, maybe you can let me know in the comments below, and I'll be excited to bring more and more of these videos to you. So the final approach in forex trading is hybrid analysis. So I had mentioned that hybrid analysis is the combination of technical and fundamental analysis. So so for example, let's say you have spotted a really nice bull flag on the charts, and let's say price is just moving around here, it's just consolidating here, and then price the government releases a report in favor of the currency you're trading. Let's say the currency in this case was Euro USD, and let's say there's positive information or positive news that have come out in favor of the euro. So in this case, the buy position in this pattern would be supported by the fundamental information that has come out. So if you're able to combine both the technical and the fundamental, I believe you would be in a very you'd be able to develop a really good perspective about the movement of price. If you've made it this far into the video, I truly appreciate you. And if you're new to the channel, please don't forget to click the subscribe button and share this content if you with people who may find this type of content interesting. And I'll see you guys in the next one.